Welcome back, everyone, to Mike on Money. My name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management. And thanks for joining us here this Tuesday afternoon for our live session where we do a weekly update of the markets and we take a deep dive into a topic. And we're going to talk today about melting up. Usually, people focus on the meltdown of a market, but we're going to talk a bit about melting up. So it's actually more important to identify when that's happening in the market, because that can help protect you against the meltdown that might inevitably follow behind it. But we'll get into that. But first, we're going to jump into the market information. And before we do that, as always, keep in mind that this information is, this session is for information purposes only. Always do your own due diligence or talk to a professional advisor. If you have any questions about anything we talk about today or any of our previous videos, reach out to us. Just go to mikeonmoney.com. That's a portal to all our content and our contact as well. You can email us or of course, call us anytime. Happy to discuss your situation and see how we can help you or at least point you in the right direction. If you are watching live, of course, this will be available on YouTube, on our YouTube channel for those who want to watch it later, and our podcast if you're listening to it at a later date. Again, just reach out with any of your questions, but if you're live, you can ask us questions. Just click that Q&A button. We'll try to get it to you today while we're on live, but if not, we always follow up on any of the questions we get in the live sessions. So with that, we always, it seems that we always have to talk about COVID before we get started. It is kind of the ongoing top news stories. Not a lot of change. I mean, obviously, we've seen some new rules across the country. The passports here in Canada are big. In the US, different local governments, different states, different cities are imposing a lot of rules about workers being vaccinated. I think is the biggest thing that we're seeing out there. And certainly there's some controversy around that. Obviously, I know the airlines in the United States are looking at firing a bunch of people who are refusing to get the vaccines. The healthcare workers in certain states, like New York, for example, all the state employees, including hospitals and retirement homes, have to have the vaccinations. Here in Canada, in Ontario, for sure have to have the vaccinations. And we're seeing a lot of employers just say you got to have the vaccine before you come back into the office. And that's having a big impact. What we're seeing is definitely the vaccination rates jump up whenever those rules are put into place. So it has taken some of the people who are on the fence and getting them over the finish line as far as the getting the vaccines go. Moving into the booster territory, and now, of course, there's new data here in Canada being submitted for, I think it's age 5 and up, was the latest study that they've put in for the vaccines. So we might see, the younger population become eligible for the vaccine as well. And obviously, with the schools reopening, they have a mask mandate now in the schools. I think from kindergarten up is what I read. So more and more we're seeing just tightening up the regulations, trying to get the vaccination rates up. Before we go into booster season, Pfizer came out with a report saying that the antibodies start to wane about the 7-month mark after you've been vaccinated. So obviously, those who are early vaccinated will be up for boosters now, and more and more as time goes on. On the travel front, for those of you like me who are AstraZeneca's, double AstraZeneca's, they've applied to the US for approval. So not that I have any big plans to go to the US, but if you're looking at going to the United States, especially one of the states that requires vaccinations to avoid quarantines, AstraZeneca should be on their window pretty quickly. And of course, the UK and most of Europe has already approved AstraZeneca's. It's the mixed vaccines that still are a little bit behind in global approval. I know the UK has approved it now, but as far as I'm aware, they're one of the few that that have kind of opened it up if you've got double or mixed vaccinations, which was of course popular here in Canada. So that's it on COVID. We continue to watch, but generally what we're seeing, of course, the Delta variant being the dominant version out there. It's way more contagious than the original, and that's what's helping it spread more and more. And hopefully the numbers continue, or the improvement has started. Hopefully they continue. I mean, there's certainly some pockets across Canada and the United States that continue to struggle with it. But with that, let's jump into the markets. And before we do, I just want to mention the Pandora Papers. If you haven't followed the news on the Pandora Papers, so this big story breaking, big story. A bunch of rich people hid money from taxes. I don't know that anyone's too surprised that that actually exists, but you know, names are going to be coming out here in the next little while. Don't worry, pretty sure I'm not on the list, not in that category, but we probably will see a little bit, not necessarily in the markets, but more on the individual side, some fallout depending on whose names are on those lists. You know, politicians, you know, Putin's on there, no big surprise as well. But you know, we're going to see more and more as time moves, as the report gets analyzed more and more. I think there was several terabytes of data that was released. So with that, let's take a look at the U.S. markets. So in the U.S., global markets rather, in the U.S. this week, we're looking for the U.S. trade numbers for August, also the manufacturing index, to see how those are shaping up as we come out of the summer months. Of course, looking at Canada's trade for August as well, and heading into third quarter earnings season with Pepsi kind of announcing later this week. On the stock front, we did see the futures pause from the sell-off that we saw yesterday and a bit last week as we move in more into a stable trading week. And certainly we're seeing the energy numbers increase, the prices increase, while technology is selling off. So no big surprise on that front. Though we've been talking about it now for months. You know, at the beginning of the summer, that shift was going to be happening this year. We saw a big rally in the stock markets last year, or sorry, in the tech markets last year, while energy slumped. And now as we come out, as the world comes out of the shutdowns, we're seeing those energy demands spike up, and we're seeing energy prices rise, and you know, valuations kind of being relooked at when we look at the tech side of things. So we're seeing that unfold in September here, or in September going into October, and that trend should actually continue. You know, big chunk of the recent decline, as I mentioned, around the techs is around bond yields as well. So bond yields have gone up, you know, around those inflation numbers, and that it really affects tech companies, because tech companies, you know, trade on future value, and a lot of that future value is reinvestment into growth and new technology and acquisitions, and all that is based off of, you know, financing dollars. So if the financing cost is going up, that's going to affect their future value. If any of you out there are, you know, someone who spends a lot of time on Facebook, Instagram, or WhatsApp, you had a lot of free time yesterday, because for the most of the day, those three were shut down or were offline for most of yesterday. Still haven't read a ton of report as to the cause of that. Obviously, it was main failure, server right at Facebook level. It wasn't your provider or anything like that. And that happened while Facebook's whistleblower, Frances Hogan, was testifying. And she's testified today, but she was testifying to yesterday in court just about Facebook's business practices and whether they put money ahead of the greater social good. I'm not going to be overly shocked if they put money ahead. Certainly, Facebook as a company has demonstrated in the past that that's been their philosophy, is they've not necessarily protected the people or their users over their bottom line. And we've seen that with, you know, how they use your data, how they repackage and resell that data, or for money allow external companies access to your data. So we were going to see more and more is that the testified in front of Congress today. We'll get more information, but I don't think there's going to be anything overly new that's going to come out of these testimonies. I think it'll just be what kind of actions the governments or courts take against Facebook for perhaps some of their activities that they've done over the last few years. And this goes around, you know, everything from the January 6th insurrection all the way to you know, international you know, genocides, discrimination around the world. So Zoom, of course, we're on Zoom right now. Zoom, the video communications took off. The stock price took off through the pandemic as everyone had to go online, and they became kind of the mainstay. There's other competitors out there like Microsoft Teams and Google Meet and others like that. But they were in the process of trying to do a $15 billion acquisition of a call center software firm called Five9. That fell through as, you know, kind of one of their first attempts to do a deal, do an acquisition deal. And I think they learned a lot of lessons, you know, what it takes, what goes into that, and also trade in their paper, because their stock price, of course, is their main currency that they're using. And they've never been, you know, they haven't in the past been in a position to take advantage of that. So they stepped away from that deal, but I'm sure we'll see them back at the table once they find something that's a better fit. Well, in the U.S., the state Fed bank chiefs, both in Dallas and Boston, were vacated. So the Fed Reserve Chair Jerome Powell is out there creating a pool of diverse candidates for those jobs after, you know, the Dallas and Boston existing Fed chairs were asked to step out due to their personal trading activities. We're seeing that a lot. You know, there's actually in the United States, there's actually a group that follow the senators' trading activity and have made money just because, you know, of course, the Senate has access to you know, new laws, new regulations that are coming into place, you know, that could affect the markets, it could affect certain companies. And Nancy Pelosi is one of the most popular one that people follow, or as she would put it, she doesn't trade, her husband trades, but he's done quite well over the last year. So, you know, all things being equal, there's probably more than just these two that are trading off that information. Hedge funds are flocking to oil. We talked a bit about this a couple of weeks ago. You know, as that energy shortage worsens. Shortage is a strong word. I mean, certainly demand has increased, and we've gotten back to the demand levels of pre-pandemic on the energy front. But at the same time, remember OPEC Plus, which we're going to talk a little bit about today, during the pandemic, cut supply, right? They turned off production on purpose because demand wasn't there. So now that supply is ramping up slowly, but that of course is driving up the price of oil. And you know, that's the goal of OPEC, is to achieve better pricing for the members while meeting global demand. Also in the US, the factory orders are gaining steam. Again, this just goes back into the supply chain challenges that we're seeing out there. Obviously, factory numbers continue to stay strong as the supply chain tries to keep up with demand, or the backlog of demand that we saw during the reopening. As I mentioned, OPEC Plus sticking to the plan to gradually increase that oil output. You know, they didn't just flip the switch and have oil kind of come full supply, because they're just back to that previous demand. So it's not like we've increased demand on oil over the pandemic. It just simply we've got to pre-pandemic demand, and that's likely to continue. Despite what we see about renewable energy or the shift away from fossil fuels. I talked more about it last week. Yes, there's a lot of movement, there's a lot of technology that's happening on the renewable energy front, but switching over, right? It's not an overnight thing. It's going to take time. It's going to take years to try to get the renewable energy production levels high enough to completely or even come close to replacing the fossil fuel. So we're going to hear more and more about that transition and how long that's going to take and what the real impact's going to have. On the IPO front, we continue to see more IPOs coming out. Avid Exchange filed for their IPO around 506 million. And this is Avid Exchange is a business payment process. So they're bringing their IPO out. Global Foundries shows jump in revenue as they launched their IPO paperwork for the semiconductor. Semiconductor, of course, jump in revenue, not a big surprise, is a global chip shortage. It's going to be really interesting to watch that chip shortage because right now, there's obviously the window into the backlog of chips. We see it everywhere from cars to computers. If you're into gaming or if you have a family or kids or grandkids into the gaming scene, trying to get the video cards for those computers are almost impossible or very expensive because of this shortage. But, with all this ramp up of chip production, at some point they're going to have more production than demand, and we're going to see that pendulum swing the other way. So keeping a close eye on that. There's obviously been a lot of pent up demand still in the chip supply chain, and it's not going away. In fact, estimates are at least until late 2022 into 2023 before they get caught up. But you have to be careful whenever you see any industry, and we've seen it go both ways. We've seen it in things like oil, where demand for oil increases globally. We turn the globe into a pincushion trying to find a bunch of oil, then all of a sudden we have too much supply. And if there's any bump in the growth in demand, then you have this big excess supply, which we saw during the pandemic. And although it was bigger than a small bump in the demand side of things, but all of a sudden you're oversupplied, and then you have to shut a bunch of things back down, and then over time you create a shortage again. So it's a bit of that pendulum going back and forth, and watching the chip manufacturers is going to be quite interesting here. Let's take a look at the local markets. The U.S. specifically, the Commerce Department is scheduled to report a trade deficit slightly higher in August and July, and again, just as the supply management kind of picks up, trying to catch up on those backlog of orders out there. Down in the U.S., they have this program called the Fed Listens, where they talk to local community leaders to discuss, how the pandemic has affected the workforce, small businesses and families, to get a better idea of how they're going to manage, the reopening, which is in full swing, but at the same time, how can they take or how can they, stimulate the economic growth as quickly as possible. As I mentioned early, Pepsi is going to be reporting and expected to see a rise in third quarter as we see those restaurants and theaters kind of reopen, where, soda, I think I talked about it last week maybe, or the week before, potatoes were really hard hit during the closures because so much of their demand comes from the restaurants or people going out. And that's the same with the soft drinks. So as that reopening has happened, we've seen them, their sales and demand pick up dramatically. And now it's just the battle between the global supply chain affecting shipments and costs on the products. Also in the US, Facebook, I mentioned Facebook, Instagram, WhatsApp was down pretty much for the whole day yesterday. Did affect their stock during the day, but you also had the whistleblower out there. So what's affecting that? is up a little bit, or was up a little bit this morning on open. I think it was around 1.3, 1.5%. I haven't followed it too much during the day this morning, but it will probably come back a bit. Again, likely the outcome of the whistleblower is going to be penalties, or just more fuel for that antitrust argument that we're seeing, not just in the US, but globally. Pharmacy chains. So, your local pharmacies, a trial in the US has just started. And it's the first trial going against the pharmacies themselves. And this is towards the US opioid epidemic, which of course we have up here as well. So in these cases in the past, it's been the manufacturers, the producers, the developer of the opioids. Purdue Pharma, of course, being kind of at the center of it, all that. But now they're going after the pharmacies themselves. And it's really interesting. Don't quote me on any of these numbers. Actually, I'll stay away from numbers. But the pharmacies themselves. One report I was reading, a pharmacy in a smaller town in the United States filled over 1 year. And here's where I'm vague on the numbers, but they filled more prescriptions, and it was something like enough prescriptions of opioids that everyone in the entire city could have had. I think it was something like 3 to 6 months of prescription use. So obviously, not everyone in the entire city were on opioids or prescribed opioids. Just that, there was fraud going on, there was sales going on. So this is what the case is focused on: is the pharmacies, any kind of certain tier of medications, they have to report any unusual volumes or activities as part of their license and as part of their agreement to handle those prescriptions. And obviously a lot of the chains were ignoring it for sales, right? They were just happy to have good sales numbers, and they were making money. They turned a blind eye. So this is what the case is focused around. So it's going to be interesting to watch that. There's some bigger pharmacies in there as well, like CVS and Walmart. Pharmacy divisions are kind of at the center of this as well. On the US Supreme Court has rebuffed Oracle's challenge to the Pentagon cloud contract. Now, we saw this between Amazon and Microsoft as well. These contracts, these cloud contracts for the US government, or any government, but certainly the US government, are quite large. And this is a $10 billion contract for their Jedi cloud computing services that they needed. And Oracle was challenging how they awarded that contract. Now the contract's been canceled since, but they were challenging the process in which the Pentagon was awarding the contracts, and got thrown out of court. Qualcomm and SSW Partners have come together on a $4.5 billion deal to buy Veoneer, an automotive technology group. And this is an interesting, actually, not necessarily because Qualcomm's in there, but it's really interesting because when you look at cars today, I actually, see cars as almost your smartphone when the first iPhones came out, right? We had cellular phones before, we've had cars for years. But when the iPhone came out, it transformed phones, not just the iPhone, then the Androids followed, and Samsung, LG, even the Blackberries tried to change for a while. Going from a phone and a pager kind of built into it, maybe a couple simple apps, to what we have today, which you're pretty much walking around with your life in your hands. Everyone's got it, everything from your banking, to your communication, social media, etc. It transformed the phone. And I think we're seeing the same thing happen to our cars. Cars are no longer just a vehicle to get us from point A to point B anymore. The amount of technology that's going into these things, the integration that's happening. New vehicles now talk to your phone, talk to your house. They self-diagnose. They will communicate with not the dealer, usually the manufacturer, and diagnose the problem. And a lot of times these cars, it's a software fix, and it will just automatically download. It will tell you it fixed itself, and you keep going. So cars are going through this transition, And so when we see things like Qualcomm and SSW getting involved in buying up automotive technology groups, where really what we're talking about is, buying up auto part group, because these are all the components that are going into our cars these days, which is why if you want a new car that right now, good luck. Even used cars are in shortage because there's no new cars because of that chip shortage. So I find this one interesting as I see that whole industry changing as we move forward. We're seeing a dramatic, even if you take a 5-year-old car compared to a brand new car coming off the lines today, massive change. But if you go 10 years, it's incredible. The difference in technology that is now on board in those vehicles. Anyway, moving on. Eli Lilly is recalling some diabetes drugs that came out of the plant that the FDA actually pointed out earlier in the year, saying that high quality control violations specifically around this drug. So, probably going to see some fines or problems there for Eli Lilly around that recall. And obviously a lot of changes to their manufacturing oversight. In Canada, the trade balance for data for August is coming out. We're looking likely a slight deficit improvement over our deficit from July, as we imported a little bit less in August. We'll have to see more in depth on what those numbers are going to look like and what kind of that causes. Sun Life, Canada's biggest insurance provider here in Canada, is making a play for DentaQuest in the US for $2.5 billion or $2.48 billion. The Sun Life's biggest deal in a couple of decades. They're not a big serial acquirer, so this is a big move into the US for them. And it's kind of interesting move on the heels of the US looking to expand Medicaid to provide dental coverage in the United States. That's part of the, Biden's big plan. That dental coverage will be part of Medicaid down there. So it's interesting if they're going in for that potential marketplace. Although if the government does go into it, obviously there's going to be pricing pressure. Much like we see in Canada, dentists have to follow or at least price off a prescribed pricing guide for their services here in Canada, and that's not even government run dental plans. On the exchange front, the dollar recovered a little bit after pulling back. Just a bit of a sign that people have gotten a little hesitant over the last week in the market's fallen, or market volatility, I should say, as people kind of have a flight or move into safety a little bit, not a ton, but we did see the U.S. dollar improve slightly with that shift in the markets. The U.S. monthly job data is coming out Friday. It's of course expected to be stronger. No big surprise that there's a shortage of workers out there, and that's going to transcribe to better numbers. But what will be really interesting is all these mandates of, as I mentioned at the beginning, of the vaccine, having to have a vaccine to go back to work, and whether that's going to affect things on the job front. As I mentioned, the yield rose a little bit over the week, and that trend will probably likely continue as we move into more inflation this year. Oops. Here we go. So let's talk about the melting up the market. So if you're not sure what melting up is, it's not a popular term. It doesn't happen very often in the markets, but it does. It's basically a sustained and often unexpected improvement in performance of an asset or asset class. So markets going up when we don't expect them to, or going up faster than we expect them to. And it's often driven by the stampede of investors, who have that, what do they call that? FOMO. They don't want to miss out, right? So not to pick on cryptocurrencies or Bitcoin, but there's probably a lot around that where people are jumping into the investment just because they think they should, because money's being made there, other people are investing in there. Why shouldn't they, or why aren't they? In reality, as with any investment, you should really know why you're buying it, what's the fundamental reason and how it fits in your portfolio. And for a lot of people, especially, I'll pick on the crypto again, is they don't know why, other than they think it's going to go up, but they don't know what those driving forces are, other than other people are buying it. And that's that kind of stampede and the people jumping in. It usually happens near a peak market cycle, so investors get swept up in the emotion of rising markets and the rising tide of the markets. And we see this melt up, and we've seen it in the past. Oops, wrong way. We've seen it in the past, and a lot of the things we hear, especially from analysts out there, always makes me nervous when I'll be having a conversation with an analyst and say, well, is this pricing justified, or what's going to help them recreate the growth they saw last year to compared to the past. And the line we get a lot is, this time is different, and that's always a concern in life, because it can be different if fundamental material changes happen to that market or that particular sector, but most times it's not. That optimism, easy credit, right? Cheap money, and really loose terms. And we saw that in 08. Now, that's not what we're talking about here, but we saw that in 08. People could get loans, they get mortgages. Those the terms have tightened a bit, but the rates are so low. Money is easy and cheap right now. There's been whenever we have a melt up, it's usually there's a big rush of initial IPOs, initial offerings, or secondary offerings, bought deals. And the end of 2020 and early 2021, been record numbers around IPOs and record performance around those numbers, because the valuations have been pushed up on that high optimism. Risky stocks outperform value. Certainly the story in 2020 started to shift a bit in 2021, but those growth stocks, the riskier, aggressive stocks, outperformed in 2020 for sure. One would expect investors to exhibit caution in this kind of environment, but it's actually opposite. People want to kind of jump in and not miss out. And given Fed's ongoing operations, investors should believe that they should protect from the downside, and believe that they have downside protection, but that protection can shift on a dime pretty quickly. So we've since 1900, we've only seen it in kind of the 1920 to 1929, kind of the depression, or leading into the depression, and of course 95 to 2000 when we went into the dot-com bubble crash. So I'm not insinuating that's what's going to happen here. Just simply, there's a lot of signs happening that we might be in a melt up, or we might be approaching a melt up. It's hard to predict when it's going to end. It's usually, represented by a sharp rise in valuations. And if you chart out last year, of course, we definitely have that. But even if you go back several years, the line's still going up with some blips along the way, but it's still going up. And the investing public believes future earnings will justify, the higher prices, right? So, a growth stock, a tech stock, take Zoom for example, had a massive growth up in its value, but can they replicate the growth that they saw during the pandemic? Is there going to be that many new subscribers jumping on board, or are they going to start losing subscribers as people come back into the office? Those are just factors you have to look at, and that's what you have to be concerned about. What does history tell us? Well, melt-ups can last longer than logic would predict, which is me. Don't run away from growth. Don't run away from the markets if you're concerned. It doesn't mean it's ending tomorrow. Even if we are in a melt-up, it can go on for a long period of time, and that's where being smart about your investments and knowing why you're in positions make a ton of sense. As I mentioned, the preliminary or prevailing psychology is, this time it's different, generally isn't. Valuations are dismissed in exchange for, momentum. You hear a lot about momentum investing, ride the wave, until the wave crashes down. And if you've ever been surfing, when the wave crashes down, it can hurt. So be careful about that. Investors take on excessive leverage, because the market can't lose. Real estate's a popular or analogy I like to use here, because yes, real estate's a great investment. It's been an incredible investment, especially here in BC. But over time, it has ups and downs, and the downs tend to last a long time. And usually when we see a melt up in real estate, and I'll use the example of the late 80s in Ontario, where people were speculating, and they were, going and, pre-buying, and, the pre-purchase, and buying up 2, 3, 4 condos with, small deposits on each one, never planning to actually close on them, planning to flip them before the condo is even completed, or right after the condo completes. And then what happened was the music stopped, right? The prices crashed by more than half in a matter of 2 or 3 months. And all these people had these deposits, which they were either going to lose and take a huge credit hit, or close on the property with massively lower valuation than what they paid. So we see that in the markets as well, as the people jumping on, leveraging, or putting more money at risk than they should, or taking more risk in their portfolios than they should, just because they're worried about missing out on that growth. And well, what is required to end a melt up? Well, that anticipation, some event will change the psychology from bullish to bearish, and you'll see a massive shift into a meltdown, which is inevitable, just how hard the meltdown is going to be, or will be. So how do you protect yourself in a melt up? So you tighten up your portfolio risk. So just really pay attention. Is the risk in your portfolio appropriate for your situation? And again, go to mikeonmoney.com, reach out, give us a call. Happy to take a look and kind of give you an assessment of if that risk looks appropriate for your situation. Take profits in big winners, right? I always tell people, if you've got a big winner, don't be afraid to take money off the table. Even if it keeps going up, you've had a good win, take some money off the table and move that into, rebalance it to other positions. Sell laggers or losers. Don't sit on the dogs just because they're down. Because if they're down in a good market, if something goes wrong in the market, it's probably going to go down way more. Don't chase after a fallen position. Just say it didn't work. It happens. Move on. Take that capital and put it somewhere more appropriate for your portfolio. Raise cash. Rebalance the portfolios. To your target weightings. Again, that goes back to make sure your risk in your portfolio is properly positioned, and really take notice through all that meltdown talk. I'm not telling you to sell and go to cash. There's great companies out there that even if we saw a meltdown or a pullback in the markets, they're going to be fine. Volatility is your friend in a portfolio. If you're properly positioned for risk and you're properly positioned to take advantage of that volatility, you will do well. But you'll never time it to go to cash. If you went to cash today and this lasted another 8 months, that growth that you had missed out, you might not make it back, even if you buy in at the low at the other end. So going to cash is not the solution. Maybe raising a bit more cash in your portfolio to protect a little bit might be warranted, dependent on your risk levels. But just going to cash is not the way to do it. So that's all I have for you this week. I know I went long. Sorry for that one. But thanks for coming out. Go to mikeonmoney.com, subscribe to the channel. Send us in any of your questions that you might have, or what you'd like to see us cover in these videos. Always happy to get suggestions and feedback. Thanks again, everyone. Take care. Enjoy your week.